It takes us to our talk of the tape. Can you believe in the broadening? Let's ask Dan Greenhaus, Chief Strategist for Solus Alternative Asset Management, with me at Post 9. Welcome back. It's good to see you.
Thank you, sir.
We got quite a market. You know, strategist today, the trends remain overwhelmingly positive. Wolf Research, momentum remains very strong. Is that how you see it?
Yeah, I think so. I mean, we have to be cognizant of the fact that the rest of the market isn't doing as well as the top tier stocks, for sure.
Starting to, though.
Yes, they are starting to. But whenever you have this level of, there's a reason why everyone's talking about late 1990s comparisons, given the outperformance of, you mentioned NVIDIA and some of the other large tech stocks, no longer Tesla, but some of the rest. Mm-hmm. But you should be conscious of the fact that they're doing a lot of the heavy lifting here. But even outside of that, as we've talked about ad nauseum and other guests as well, plenty of other stocks, plenty of other sectors are contributing here. It's been pretty impressive and it remains so.
I mean, can you believe in it? It's sort of my central question of the day. Can you believe in the broadening? Because, I mean, that matters a lot. Believe it? Well, because you've had it before, but it's been short-lived. A couple days here, a couple days there, but not a trend to really believe in.
Not at the headline level, no. But, again, to repeat, there's a number of industrial stocks that are sitting at highs that have secular tailwinds.
That's fair. The industrials chart looks great.
Yep. A number of consumer names, not necessarily the retailers, although Abercrombie and Fitch is to the moon, but a number of consumer sectors like the hotels, anything associated with travel obviously remains pretty strong. So the home builders, of course. It's not just 5 or 6 tech stocks that are going up. Plenty are going up. They're just doing the heavy lifting.
You scoff at the notions of, comparisons to 99. You say, as some would suggest, it's more like 95 than 99, right? Fed pulls it off. They pull off the soft landing. They do a few cuts. The economy hangs in, and everything's great for the next few years.
Sure. Admittedly, there are similarities and there are differences, and there are a lot of people talking about late 90s comparisons. I think the point I wanted to make to the producers, and I would make here on air, is the level of egregious overvaluation that we saw in the late 90s is nothing like what we're seeing today. There are pockets, of course. Eli Lilly, very expensive. NVIDIA, very expensive. But
is it? Is it?
If you believe in forward earnings.
I mean, yeah, it costs a lot to buy a share, but
sure.
But the valuation's actually now cheaper than its 10-year historical.
Yes,
NVIDIA.
but still 50 or 60 times forward.
Well,
which
it's
is
30. It's like 33.
Depending on your forward earnings. But listen,
don't let the facts get in the way.
No, we don't care about the facts here. but my point is that when you go back to the 90s, especially towards the end, you had stocks like PeopleSoft and other names. Oracle was trading at 100 times forward earnings. The market as a whole was trading at 30, 35 times earnings, depending on the NASDAQ was trading at 120, 125 times
so we're
forward.
nowhere near that.
We're nowhere near that. Now, that on its face is insufficient, because the fact that you were not as overvalued as you were in 1999 does me little to no good. But the 95 analogy, I think, is warranted in the sense that then you were at the forefront of the evolution of the internet and the names that were associated with it. And when you go back and you read some of the reporting at the time, the New York Times, CNN Money, Wall Street Journal, the commentary then is very similar to what you hear today from the like of Dan Ives, in the sense that we're on the doorstep of this new industry, this new paradigm shift.
Oh, you think it's going to end badly?
Well, listen, when something's trading at 50 or 60 times earnings, whatever it might be, not NVIDIA, let's say, but in general, then those things usually end badly. I defer to my friend Ben Snyder and David Kostin over at Goldman Sachs, who've done work in the past. I don't remember when or the note, but what stocks usually grow into their valuations. And historically, stocks trading at what we'll call excessive valuations, to oversimplify things for the viewer, usually don't grow into their valuations. That's not always true. It's usually true.
Well, we get CPI tomorrow. We're going to get PPI this week as well. What's riding on this? This is all in the narrative, right?
Sure.
Inflation is going to 2%.
Yes, it's on the way.
And the Fed's going to cut before it gets there.
The Fed is going to cut before it gets there. Skate to where the puck is going, Scott. The idea that they need to wait to 2%, never an idea that they advanced or an idea that the market should have believed in. The trend is clearly downward. I think the so-called last mile that we're all focused on right now becomes the focus. How long does it take you to get from 3% down to 2%? At the same time, from an investment standpoint, I'm not sure that I care. And what I mean by that is, from a market forecasting standpoint, if someone told me inflation over the next 5 years will be 3% rather than 2%, do I really think that the earnings trajectory, the economic trajectory will be meaningfully different? I'm not sure that it will be.